You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, How Does an Inefficient Market Get That Way? Written on 15th of July, 1994. Let's dive into the timeless insights that continue to influence investors today. All right, so let's dive into something. Might sound a bit technical, but I promise it's anything but boring. We're going to be talking about inefficient markets and how spotting these inefficiencies can lead to, well, incredible investment opportunities.
That's right. We're going to be using a memo from Howard Marks to guide us, a legendary investor. The memo is titled, How Does an Inefficient Market Get That Way? It was written back in 1994, but the insights are, well, incredibly relevant even today.
So we're time traveling back to the 90s,
Yeah.
getting a glimpse into the mind of this Wall Street titan. I'm already hooked. What's the big idea here?
Well, Marx starts by defining what he means by an inefficient market. Essentially, it's a market where prices don't always, accurately reflect the underlying value of an asset. You might have some assets that are overpriced and others that are underpriced.
Okay, so that's where things get interesting. Because in an efficient market, everything's fairly priced based on all available information. But in an inefficient market, there's this potential to find hidden gems.
Right. Exactly. Imagine like a bustling marketplace, but instead of everyone having perfect information about the value of the goods, some people are overpaying while others are getting incredible bargains. That's the potential of an inefficient market. It allows, for skilled investors to spot those mispriced assets and potentially earn superior returns.
That makes so much sense. Now, to illustrate this concept, Marx uses a specific example from 1994, high-yield bonds, also known as junk bonds. Can you set the scene for us?
Sure. Back in 1994, these high-yield bonds were offering a significantly higher yield compared to, safer investments like treasury bonds. And that higher yield, well, that's what we call a risk premium. Investors demand a higher return for taking on, well, more risk.
Okay, so on the surface, it seemed like a fantastic opportunity to earn higher returns. Yet, investors weren't exactly, flocking to buy these bonds. What gives?
Well, this is where Marx's insights into investor psychology, really shine. He argues that the inefficiency in the high-yield bond market at the time was largely driven by psychological factors, specifically fear.
Okay, I'm starting to see where this is going. Fear can be a powerful motivator, especially in the financial markets.
Absolutely. Investors were still reeling from the collapse of the junk bond market just a few years earlier. The negative publicity surrounding junk bonds, the association with figures like Michael Milken, all of that created this cloud of fear that overshadowed the potential returns.
So even though these bonds might have been undervalued, fear kept investors away. It's almost like they were letting their emotions dictate their investment decisions.
Precisely. And that's the fascinating paradox. This fear, this irrational behavior created a unique opportunity for those investors who were able to look beyond the headlines and assess the true value of those bonds.
So essentially, understanding the psychology of the market, recognizing where fear or other emotions might be, distorting prices, can be a powerful tool for an investor.
Exactly. And it's not just limited to, junk bonds. This principle can apply to any asset class or investment where emotions are driving prices away from their fundamental value.
This is starting to feel like we're uncovering a secret code to the market. But before we get too carried away, let's pause here for a second. We've talked about the potential of inefficient markets, but there must be downsides too, right? What are some of the cons of this approach?
You're absolutely right. There are definitely some potential downsides. One of the biggest challenges is that it's not always easy to identify, those mispriced assets. It requires a lot of research and analysis and a deep understanding of the underlying fundamentals of the investment.
So it's not as simple as just saying, oh, everyone's scared of this, so it must be a good deal.
Yeah, no, not at all. You need to be able to separate the emotional noise from the actual value. It's like, sifting through a pile of rocks to find those hidden gems.
And even if you do find a potentially undervalued asset, there's still the risk that the market might not correct itself anytime soon. You could be stuck holding an investment that, everyone else continues to shun.
Yeah, that's a very real risk. Sometimes the market can stay irrational longer than you can stay solvent, as the saying goes. It requires, patience and conviction to to stick with your analysis, even when the crowd is heading in the opposite direction.
So this approach isn't for the faint of heart. It's not just about being contrarian for the sake of it. It's about having a well-reasoned thesis and the discipline to see it through. But let's talk about when these ideas about market inefficiency, don't apply. I mean, it can't be a universal truth.
Right. Right. You're right. There are certainly situations where this approach might not be as effective. For example, in markets that are extremely liquid and heavily traded, like large cap stocks,
Yeah.
it's going to be much harder to find significant mispricings. That the sheer volume of trading and the constant scrutiny of analysts, those tend to keep prices in check.
So the more efficient the market, the less likely you are to find these opportunities based on psychological factors. It's almost like the market itself is correcting for those emotional biases.
Exactly. But here's the thing. Even the most efficient markets can experience periods of, irrationality. Think about, the dot-com bubble.
Right.
Or the housing crisis. Those were times when even, sophisticated investors got caught up in the hype and made decisions based on emotion rather than logic.
So no market is completely immune to the forces of human psychology. There's always that potential for those emotional waves to sweep through and create opportunities or, pitfalls, depending on how you navigate them.
Precisely. And that brings us to a crucial point. Recognizing these inefficiencies is only half the battle. The real key is knowing how to capitalize on them. So, what are some actionable insights for investors who are looking to apply these ideas?
Okay, so let's get practical. We've talked about the concept, the pros and cons, and when it might not apply.
Yeah.
Now, how can our listener, actually use this information to potentially improve their investment outcomes?
Well, it starts with, developing a deep understanding of the forces that drive markets, both rational and irrational. This means, going beyond just looking at charts and financial statements. It means, studying history, understanding human psychology, and being aware of your own biases.
The self-awareness is key. Knowing your own tendencies, how you might react to fear or greed, that's crucial to avoiding those emotional pitfalls.
Absolutely. And then it's about, being a contrarian thinker. When everyone is panicking and selling, that's often the time to start, looking for opportunities. But as we discussed, it's not just about, blindly going against the crowd. You need to have a solid thesis based on fundamental analysis.
So it's a combination of understanding market psychology and having a strong foundation in the fundamentals of investing.
Yeah.
It's about being able to see both the forest and the trees,
Oh, right.
The overall sentiment of the market and the specific details of an investment.
Exactly. And here's where it gets even more interesting. This approach to investing, it isn't just about, making money. It's also about understanding the deeper philosophical foundations of how markets work.
Okay, I'm intrigued. Let's go deeper.
Yeah.
How does this, tie into a broader philosophical perspective?
Well, traditional, efficient market theory, it suggests that prices always reflect all available information. But
Sure.
as we've seen, that's not always the case. Markets are, driven by human beings, and human beings are complex, emotional creatures. Our decisions aren't always rational, and those irrationalities, well, they can create inefficiencies in the market.
So this idea, it challenges that purely rational, efficient market view. It acknowledges that, human behavior plays a significant role in shaping market dynamics. And by, understanding those human elements, those psychological factors, we can gain a deeper understanding of how the market actually works.
Exactly. It's about recognizing that markets are not, simply abstract systems governed by mathematical formulas. They're living, breathing entities influenced by the hopes, fears, and biases of millions of individuals.
That's a beautiful way to put it. And it's a much more nuanced and frankly more realistic way to approach the market.
Yeah.
But I'm wondering, if you take this philosophical perspective, does it ever make sense to believe in an efficient market? I mean, is there ever a time when prices actually do reflect all available information?
That's a great question. And the answer is it depends. There are certainly times when markets behave more efficiently than others. For example, in markets with a high degree of transparency, where information flows freely and there's a lot of competition, well, prices tend to be more accurate.
So the more information is available and the more people are analyzing that information, the harder it is for those inefficiencies to persist.
Mm.
It's almost like the collective wisdom of the market is working to correct those mispricings.
Exactly. But even in those seemingly efficient markets, there's always that potential for human behavior to throw a wrench in the works. Think about, the flash crash of 2010, where the market plunged and rebounded within minutes. There was no fundamental reason for that, volatility. It was purely driven by algorithmic trading and the psychology of the market.
So even with all our technology, all our data analysis, we can't completely eliminate that human element. There's always the potential for those emotional waves to disrupt the rational flow of the market.
Precisely. And that's why it's so, important to have a balanced approach. You need to understand the principles of efficient markets,
Yeah.
the power of, data and analysis, but you also need to be aware of the human element,
Yeah.
the psychology of the market,
Yeah.
and how those forces can create both risks and opportunities.
This is a fascinating conversation, and it's making me rethink my entire approach to investing. I want to thank you for sharing your insights with us.
You've been my pleasure.
But before we wrap up, I want to leave our listeners with a final thought. We've talked about how fear can drive prices down and create opportunities. But what about the other side of the coin? What about greed? Could that be a source of market inefficiency as well?
That's a brilliant question, and one that we'll have to explore further in another deep dive.
Yeah, this has been such an insightful conversation. We've really covered so much ground, from the basic definition of inefficient markets to the deeper philosophical implications of human behavior in the market.
Yeah, it's been a fascinating discussion for sure, and it really highlights how understanding these, concepts can be a real game changer for investors.
As we wrap up our deep dive into Howard Marks's memo, what are some key takeaways that our listeners should really try to remember?
Well, I think one of the most important takeaways is that markets are not always rational. Emotions, like fear and greed, they can really drive prices away from their fundamental values, creating opportunities for those who are able to, maintain a clear head.
It's almost like we have to train ourselves to think differently, to see the opportunities where others see only risk.
Exactly. And that's why Marx's example of, high yield bonds in 1994, it's so instructive. It shows how fear can create a mispricing and how those who are, willing to look beyond the headlines can potentially, profit from it.
But it's not just about recognizing, fear, is it? It's about understanding all the different psychological factors that can influence market behavior.
Absolutely. Things like, herding behavior where investors blindly follow the crowd, or anchoring bias where we get fixated on a certain price point. These can all, lead to irrational decision making.
So self-awareness is crucial. We need to understand our own biases and tendencies in order to avoid falling into those psychological traps.
Precisely. And we also need to be, willing to go against the grain, to be contrarian in our thinking. But, remember, it's not about being contrarian for the sake of it. It's about having a well-reasoned thesis based on careful analysis and a deep understanding of the fundamentals.
So it's a combination of art and science, the art of understanding human psychology and the science of fundamental analysis.
Yeah, I love that analogy, and it's a combination that can lead to, truly remarkable results in the market.
Well, this has been an incredible journey. We started with a memo from 1994, and ended up exploring the deepest philosophical foundations of market behavior.
And along the way, we uncovered some powerful insights that can help investors, navigate the complexities of the market and potentially achieve superior returns.
I think that's a perfect place to wrap up this deep dive. Thanks again for joining me. It's been a pleasure.
The pleasure was all mine.
And to our listeners, thank you for taking this deep dive with us. Remember, the market is a complex and ever-changing landscape. But by understanding the forces at play, both rational and irrational, you can gain a significant edge. Until next time, happy investing.